Welcome to the August 9th edition of the Fats, Fuels, and Oils webinar. This week, we're going to cover vegetable oils. We'll talk a little bit more about what's going on with the weather, because that continues to be an important factor in the oilseed complex more broadly, but vegetable oil prices for, if not for the next couple of weeks, certainly for the next several months. And then we'll go through our usual look at biofuel margins, and I'll talk a little bit about what I wrote about this week in terms of what's going on with RIN prices. As I said, today has not been great. I've been having some internet problems. You can't see behind me, but we're also having some storms. So there is some chance that my electricity will go out briefly. I think the worst of the storm has passed, and so usually the lightning seems to be at the front of the storm, and that's when we lose power. But if we lose power, hang in there. I'll be back up either on my computer or on my phone as quickly as I can possibly be, but hopefully that won't happen. But because of that, you'll notice that the articles haven't updated yet. They're mostly written. I just need to finish up one, the fats and oils article. I just have a couple paragraphs left with that. So that should be posted shortly after we finish the webinar. However, I did update the data. And so let's get into it and start to talk about what's going on in the soybean oil market. So we had prices they've been trading in this 60 to 65 cent range for a little while now. It seems like there is a pretty hard floor, I think, around 60 cents. The market doesn't seem to really want to trade below 60 cents. It's made a couple of attempts to get down below that level. But I think that you've had a couple of things happen, particularly this past week. You've had a rebound in soybean futures, where the November contract is trading back above $14, and so that's limited the downside for soybean oil. Although we still have the situation where the oh, my camera just froze. Please don't tell me that I just lost internet again. All right, I'm going to continue on, and there we go. Sorry about this, guys. We still have the situation where the oil share position held by speculators is relatively low. And so even though soybean prices have recovered, that's been more reflected in soybean meal prices than it has been in soybean oil prices. So oil hasn't been able to get back above sort of this 65 cent level. And so we've kind of had this range bound trading for a little while. Given the outlook, as you can see from the forecast, we expect that prices will remain at or above these levels, at least into harvest. And then typically there's a fairly strong seasonal during harvest, and then post-harvest where prices move down. That's also the beginning of the Brazilian planting season. And the last 2 years, Brazil's crop has been impacted by La Nina. And so expectations for Brazil's crop have started around like 140 million tons, and then the crop has been sort of sub 130 both years. This year, we're expecting the crop to be around 150 million tons, and it looked like La Nina was fading, although recent predictions by NOAA suggest that maybe La Nina is going to make a reappearance for a third consecutive year. And that would suggest that maybe the Brazilian crop will not be all that that we expect it to be right now. Our forecast is based on normal weather conditions in South America, and so that's why you get the pressure there. If Brazil does produce 150 million ton crop and Argentina produces a trendline crop or better, then that's likely to pressure soybean prices, which will translate into lower soybean oil prices. However, let's go back to the U.S. and the changes that we've seen, or the sort of the lack of changes that we've seen in the weather pattern over the past week. Um, Last week or the week before, we looked at those maps that were probably relatively hard to see on your end, that kind of showed a ridge of high pressure over the middle of the Midwest, or somewhere thereabout, and that meant that if you looked at the 6 to 10 day outlook and the 8 to 14 day outlook, you had above average temperatures and below average rainfall over the much of the U.S. Corn Belt. And we're getting into the most critical time for soybean yields, because we're heading into pod filling, which occurs during the second half of August and the first part of September. And so that outlook suggested that yields probably would be below the 51.5 bushels per acre that USDA predicted in their July report. Now, it's important to note that the July yield prediction is based on trendline yields. The August prediction will be the first prediction that's based on objective data. And so there typically is some adjustment, just because they're going from sort of a model predicted yield to one that is based on conditions. And if you look at the weekly crop condition reports in the 1st of July, whatever that good and excellent percentage is, versus the first week of August, whatever that good and excellent percentage is, the difference between those two is a relatively good predictor of the change that USDA will make to its forecast. And if you look at that, it suggests that USDA will make a modest reduction in their yield forecast, and that is also reflected in surveys of analysts that predict that USDA will cut its yield by about a half bushel an acre when it releases its report on Friday. A half bushel an acre is not really enough to suggest it's roughly 35 million bushels of production. So it's not really enough to suggest big changes to USDA's US soybean balance sheet. And I would argue that the most likely change, if we do get that reduction in yield, the most likely change will be a cut to USDA's export forecast. So USDA forecast US exports at 2.135 billion bushels in July, and that's 85 million bushels above where we are. And so if they took 35 million bushels out of that, it would be about 2.1. That's not a big change. And it sort of mirrors what has happened in Canada over the past year. There was the drought in the canola producing regions last year. Production came way down. Canada is a big exporter of canola seed, but they're also a big crusher of canola seed. And the drought meant that they didn't have enough to do both at the levels that they had sort of the prior year. And going into the year, there was this past year, there was some question about whether Canada would export more at the cost of crushing, or would crush more at the cost of exports. And it turned out that they crushed more and reduced their exports more. They still didn't crush as much as they had the prior year, when they crushed a record 10.4 million tons. It's going to be closer to like 8.8 or somewhere in there, I think. But their exports fell off substantially more. And so any reduction in the US soybean crop is likely, USDA is likely to take the same, to mirror the changes that they made in Canada, or that developed in Canada, I guess, as the year went along. And so I don't think that the decline in yield necessarily at this point has a substantial impact on the outlook for the US soybean oil balance sheet. That said, there are still some differences, some significant differences between our balance sheet and USDA's July balance sheet. And the biggest one of those, which is the one that is always is we expect that soybean oil use in biofuel production will be substantially higher than USDA is predicting. Now, we are in the midst of updating our long-term projections, and that typically also impacts the next year's projections. And it already has a change that I made to our forecast for U.S. U.S. renewable diesel imports has already reduced the amount of feedstock demand for soybean oil. And so you can see before that change, we were at 16 billion pounds or something, and now we've come down to about 14.5 billion pounds. Um, we're still going through this process, and some of the fat and grease balance sheets have ending stocks that aren't in line with trend. I think I wrote that last week. And so I would expect that that number will still change, and I would expect it probably to continue to come down a little bit more than it has. The reduction allowed us to finally cut our import forecast from 4 billion pounds to 1 billion pounds, but that still is 500 million pounds above where USDA is. And then the other big difference is our non-biofuel use, which is at 13 billion pounds is still 700 million pounds below where USDA is. As we go through this process, any additional reduction in our feedstock demand will likely be used to raise our non-biofuel demand, because while I think that the long run sort of equilibrium for non-biofuel demand is probably around 13 billion pounds. I think 13 billion pounds is definitely at the lower end of whatever that number could be. And so I would look to raise that with any additional supply that that I can find. We probably also will ultimately reduce our import forecast a bit, although I would still probably prefer to raise non-biofuel over lowering imports. I think I'm going to have to find other ways to cut our import forecast, but first I'm going to need to raise our non-biofuel forecast. And I don't think that I probably will ultimately raise it to 13.7, but probably 13.2, 13.3, 13.4, somewhere in there is probably a number that will be closer to reality than the 13 billion pounds that that we are showing now. Okay, all of that said, we don't expect, because of what I explained about the potential reduction in yield and the fact that USDA is likely to favor a cut to its export forecast over its crush forecast. I don't expect that they're going to make huge changes to their new crop 22-23 US soybean oil balance sheet. If they do make any changes, it might be in the biofuel feedstock category, I suppose. Um, they potentially could cut that a little bit. Maybe I don't have any real reason why they would, but I can't really think of anything else that that they would potentially change in their balance sheet. In the old crop in 21-22, I think that they probably need to cut their U.S. export forecast. We are at 1.7 billion pounds right now. There's a little, there are sort of three little trackers that I use based on the weekly export data that sort of tell me whether I need to raise or lower my export forecast. And right now, what it's suggesting is that I need to lower my export forecast from 1.7 billion pounds. We've already exported enough that I'm not likely to lower my 21-22 forecast until we really get up to the end of the year and and can know with some certainty where it's the range that it's going to fall into. But what that suggests to me is that that USDA is probably looking at the same data, and given the fact that they're 75 million pounds above us, they may cut their export forecast by a bit. Um, I would also suggest that they may need to raise their non-biofuel forecast. They cut it last month, and so, like most analysts, the thing that you hate to do almost more than anything else is cut a number one month and then raise it again the next month. But based on the data that we got in the latest fats and oils report, we're pretty comfortable around 14.5. Maybe it comes in a little bit lighter over the next couple of months. But if you just look at the trend in non-biofuel use over the last several months, and what 14.5 predicts versus 14.2 essentially for USDA, I think that they probably are going to need to raise their non-biofuel projection by maybe 100 million pounds. But again, maybe they don't do it this month, maybe they do it next month, just because it's a reversal of something that you just did, and that hurts as an analyst. Outside of that, our biofuel number is below theirs, or I guess more in line with theirs than it had been. And I don't necessarily think that they will cut that, but if they are going to raise their non-biofuel forecast, typically what they like to do is they like to offset changes in one with similar changes in the other. Now, sometimes they'll let 50 million pounds or 100 million pounds fall to exports or fall to someplace else, but if they're going to cut their export forecast by, let's just call it 75 million pounds, so that they're in line with our projection, and they cut their biofuel forecast by 100 million or 125 million pounds, that would let them add 200 million pounds to their non-biofuel forecast, and that would get it at 14.4 essentially, and that's probably a pretty comfortable place. Again, maybe they don't do all of these changes on Friday, but those are the changes I think that they could do and that would be reasonable for them to do this month. Now, what I don't necessarily expect them to do is make changes that that raise their ending stocks forecast substantially. They I think ending stocks end up around just below 2 billion pounds. And so at 1.95, they're probably relatively close and pretty comfortable with where they will end up. All right, let's move on to canola, and to the person that raised their hand, we'll get to questions at the end, at the very end of this. You can type your questions into the chat or the questions part, and we'll take some time at the end to answer any questions that everybody has. So for canola, the impact of the weather is been slightly different. It hasn't been as dry in the prairies and Canadian prairies in the northern US plains as it was last year. And they got a bit of soil moisture recharge earlier in the year, and then at least decent and timely rains through much of the summer. Canola develops, it goes through pod filling a little bit earlier than soybeans as well. And so the impact of the anticipated dry weather that's coming up is a little bit less on the US or Canadian canola crops. That said, there still is some chance that USDA will cut their yield from the trendline yield that they used in July. Again, for we'll talk about this in two separate ways. For the US, any cut in production probably means a decrease in in crush, depending on what they do with imports, right? It's also very dependent on what happens in Canada. So because we only export a little bit of canola seed, any reduction in supply, essentially they can reduce exports a little bit, but then they probably will have to reduce crush a bit. Conversely, for Canada, it will be a repeat of last year if they cut their yields. What they'll do probably is decrease their export forecast a bit, and leave their crush forecast unchanged. However, if they do decrease their export forecast a bit, we are one of the primary destinations for Canadian canola seed. And so that could potentially impact our imports, and that would have the same impact as reducing yield. And so that could also impact our crush forecast and reduce that. In terms of differences in balance sheets, really for 21-22 and for 22-23, we're in pretty good agreement with USDA. We don't have any real significant differences in our outlook. The biggest really is the biofuel use in 21-22. However, unlike our soybean oil forecast, I don't really anticipate our canola oil forecast to come down that much, just based on the data that we've gotten from the EIA recently, which has shown canola oil use at around 100 million pounds a month. And so if that continues, that translates into roughly 1.2 billion pounds for the year. So maybe USDA would raise their biofuel use, and that would again probably cut their non-bio use, which is kind of the offset of our higher biofuel demand. We have lower non-biofuel use. That would bring them a little bit more into line with us. But outside of that, we don't really have any big significant differences in our outlook for the US canola oil balance sheet. Again, any changes in it will depend on one, a cut to the US yield and then subsequent change in their crush forecast, or two, a cut in the Canadian yield and then a subsequent change in their Canadian export forecast. All right, let's look at, we'll start with Canada for their canola seed forecast. So you can see, again, like I said, last year, they crushed about 8.5 and exported between 5 and 5.3 million tons. We expect crush to recover largely or close to the record 10.4 that was crushed last year. That will depend a lot on the production forecast. If the production forecast is lower, we may lower this a little bit, but primarily we would probably cut our export forecast. But again, right now you can see there are just minor differences in the two balance sheets, and so I don't know that without a big change in their yield forecast for Canada, I don't know that there's anything that I think that USDA necessarily needs to do to change, at least in my opinion, that they need to do to change their Canadian canola seed balance sheet. For canola oil, I think it's pretty much the same. There are some minor differences just in production due to the crush forecast. The one big difference here really is in domestic usage. And our domestic usage is significantly higher than USDA's. You can see USDA has it growing just slightly year over year. We've got higher domestic usage because of the Canadian biofuel program. The difficult part with that is that one, the program is relatively tough to understand, or tougher to understand. It's more complex. I think at least the credits are more complex than the LCFS credits and RIN credits combined, I think. And so establishing values for those, and then the impact on production is something that we are in the process of figuring out. And so we have uh, a forecast that is based in part on a partial understanding of those dynamics, and we've erred on the side of being a little bit high, I think. So I think that our 1.8 million ton forecast probably has some chance of coming down, but I also think that USDA's 1.07 million ton forecast probably really needs to come up. Canada's the two things. The one, the way that Canada presents their feedstock use data is not completely straightforward. They don't really separate vegetable oils out in any significant way. Now, of course, a lot of their vegetable oil feedstock use is going to be canola, but they don't really separate that out. And then fats and greases, they don't really have that. They just have sort of an other category. And there's not a lot of, they just changed their the way that they report all of their biofuel data maybe a year ago, maybe a little bit longer ago than that. But either way, there's not a lot of data, excuse me, on which to base a forecast. And so I say all that to kind of say that our 1.8 number is out there. It may be revised. It's likely to be revised and potentially substantially in the coming months as we incorporate more of the analysis of the Canadian program into our model. We have a very basic understanding of it right now, I would say. So I think this could be lower, and if domestic usage is lower, then obviously we would raise our export forecast. Again, the US is a significant importer of Canadian canola oil, and so that would increase our canola oil supply. It would just, all else equal, an increase in Canadian canola oil exports would raise our US import number, and that would raise our non-biofuel use forecast, most likely. There is some chance that it could, with the introduction of the pathway for canola oil in renewable diesel under the RFS, there is some chance that we could raise our canola oil use in renewable diesel production, but it's not, this is something that we've been anticipating and have already incorporated into our forecast. And so we don't know what the level will be yet, but given that canola oil is more expensive than soybean oil, it only works in certain places. And so we'll see once the data starts to roll in, whether it's close to our assumptions or not. But that's what it would take, I think, to make it have a significant impact, any change in Canadian exports to have a significant impact on our projection of US biofuel use of canola oil. That was not super clear. Finally, palm oil, we're going to get the monthly Malaysian Palm Oil Board report. Of course, this is the USDA forecast, which is typically runs, the changes in palm oil run months behind the Malaysian Palm Oil Board, but this is the number that we have up there. I'll put the expectations for the MPOB report, which will be released tomorrow night US time. I'll put the predictions for that up there with the article so you can see those. In general, our forecast is pretty much in line with expectations for the MPOB report. We both expect a modest increase in production and in exports, and the production increase is slightly larger than the export increase, and so you get an increase in what we expect for the estimate of month-ending stocks. Not a huge increase, and it doesn't take stocks up to a level that suggests that palm oil prices should be significantly lower. But it does suggest that the trend toward sort of higher palm oil stocks is going to continue. More importantly for palm oil, I think there's two things really that are more important probably uh, than the USDA report for sure. Let's just leave it at that. The first is the changes in Indonesian governmental policy towards exports. Uh, they announced that they're going to lower the threshold for taxes on palm oil exports. That will make Malaysian exports more competitive. And so you've had palm oil rally a bit on that news. The change in Indonesian policy is important because it does make Malaysian palm oil exports more competitive relative to Indonesian exports. But if nobody's buying, it doesn't really matter, right? And so the big question still remains whether world vegetable oil fundamentals are as tight as they have been over the last couple of years, or whether that has improved marginally over the last sort of 3 to 6 months. Now, of course, we're starting to see shipments out of at least grain shipments out of the Black Sea region at this point, and even oil exports out of Ukraine were stronger than we thought they would be going into the war or shortly after the invasion. And so you've had some return of supply of sunflower oil that has helped. Certainly, at least it's helped from the point of whatever expectations were on the day that Russia invaded Ukraine. Today, whatever you expected supply to be on that day, you probably expect supply to be greater today than you did then. And so that probably helps the world vegetable oil balance sheet look a little less tight. But you've also had you have this slowdown in the Chinese economy, and a you've had less demand from India. In addition, I think part of the change in demand in India is that they are probably, and I haven't looked at the data closely enough to know this for certain, but this is my supposition just based on the fact that we haven't seen India sort of restocking palm oil in the way that we would have expected them to over the last several months. And I think that they may be buying some sunflower oil from Russia, and so that may be limiting their demand for palm oil. In China, the slowdown in the economy may be limiting the demand for palm oil from China. Still, if you look at the various futures markets, there's the soybean oil futures market in the US, obviously the Malaysian palm oil futures market, but there are soybean and palm oil futures markets in China. If you look at the price movement over the past week and a half or so, they all sort of moved in lockstep, and they all kind of went down, and then they are starting to recover, or prices are starting to move higher. And that may suggest that while world fundamentals aren't as tight as they were 6 months ago, or that we thought they were 6 months ago, or certainly as tight as they were a year ago, they may be um, starting to get tighter again, and that would suggest that maybe China will start to buy more palm oil. And again, given the change in Indonesian government policy, that could mean that Malaysian exports will be a little bit stronger in the last couple months of the marketing year than we have been expecting. Now, the other thing that I think that's really important for the Malaysian palm oil market is the production number in in July. It's a rearward looking number, obviously, but palm oil production has a very strong seasonal trend. And if you look back over the last couple of years, you've seen that production has actually fallen from June to July just slightly by 50,000 tons or so. But if you look at the 3 years prior to that, production rose by about 225,000 tons from one month to the next. There's been a labor shortage in Malaysia, and so it's not a situation where I think like the range of possibilities is either a decrease of 50,000 tons or an increase of 250,000 tons. That's not sort of the case here. The point of the prior 3 years is just to say that the last 2 years have kind of been an anomaly. This year, you're likely to see either a small increase or a small decrease, but whether it's an increase or a decrease will be relatively important to what the rest of the year looks like, or at least what our forecast for the rest of the year looks like. If we get a small decrease or we get an increase that is a little bit smaller than anticipated, it suggests that we probably need to cut our marketing year forecast. And right now, our marketing year forecast is at 18.2 million tons. That forecast implies that production needs to rise by like 190,000 tons, either from July to August or August to September. Either way, there needs to be a relatively large increase in there someplace. If we get a small decrease, one that raises the amount that production needs to increase month over month to meet our 18.2 million ton prediction. But it also suggests that the trend probably is not is a little bit lower than expected. And so even if the sort of miss on production is relatively small, so let's say it's down 10,000 or it's unchanged from July, or from June rather. It probably will trigger a bigger cut in our marketing year forecast than that small change will imply, just because it will mean that that the trend in production, which sort of needs to fit with the again the relatively strong seasonal pattern you typically see during the last couple months of the marketing year, that 18.2 will just be a number that's too high to reach because of the big change from month to month that it will suggest. If there is some change in the situation and the labor issues, which I think the Malaysian government has taken steps to address, and I think have gotten a lot better than they were a year ago or at the height of the pandemic, certainly. If that starts to happen, then maybe that number doesn't need to change by that much. But if output in July isn't sort of above our expectations or well above our expectations, I think it's going to be hard to maintain that projection. That will probably have more of an impact on our export forecast than anything else. We probably will use any reduction in our production forecast to reduce our export forecast rather than domestic use, or to cut our ending stocks forecast. Now, we may reduce domestic use a little bit depending again on what the data looks like for July, but at our ending stocks forecast is 1.75 million tons. I have a hard time thinking that you're going to see something that is significantly below that level, even if we do cut our production forecast. Okay, let's move on to biodiesel and our gross margins. So for the last couple of weeks, we've seen gross margins for or our estimate of gross margins for renewable diesel and biodiesel move in the same direction, which is not something that we had seen for quite a while. This week that didn't happen. We had a rebound in biodiesel margins, primarily due to a decrease in feedstock costs that more than offset a small decrease in the price of biodiesel, excluding credits. Uh, Conversely, for renewable diesel, we had a recovery in fat and grease prices and a reduction in renewable diesel prices. And so the margin for our assessed margin for renewable diesel declined more significantly, or declined fairly significantly by 25 cents or something close to that, which is roughly 10%. Um, you can see from our forecast here that while we expect renewable diesel margins to kind of recover a little bit in the short term, we do expect them to kind of remain under pressure kind of going forward. And that's due in part to the fact that we did see a faster bounce back in fat and grease prices than we have in the soybean oil market. And so we've talked about this idea that that fat and grease prices may provide some indication of how much sort of excess supply there was available to the biofuel industry, and if fat and grease prices remained at or close to record levels, that maybe we were sort of using up all of the fat and grease that we could in biofuel production. And I kind of held on to that idea for a little bit because after soybean oil dropped so much, we didn't really see a similar move in fats and grease prices at the time that we would have sort of expected it to happen. It did start to occur a little bit later, but then it started to bounce back. And so again, that brings me back to this idea that maybe the excess supply of fats and greases that are available to the biofuel industry, or I guess to put a better way, the biofuel industry is demand is probably straining the supply of fats and greases, and there just isn't a whole lot out there that a whole lot more out there that they can get to. And if that's the case, it will probably pressure margins for biofuel production from fats and greases. Again, if you think of the our assessment of renewable diesel as much an assessment of producing biofuel from fats and greases as you do um, a renewable diesel assessment, and our assessment of biodiesel as much an assessment of producing biofuels from vegetable oils or soybean oil more specifically, um, then the forecast trend kind of reflects the difference in the feedstocks in our outlook for feedstock prices. Again, our renewable diesel feedstock mix assumption is 50% tallow, 25% DCO, and 25% UCO. And our feedstock assumption for biodiesel is 75% soybean oil, 25% yellow grease. And so you can see that the difference there, and why I say that while we call this the renewable diesel assessment, and we call this the orange line the biodiesel assessment, and they are based on the economics of biodiesel and the economics of renewable diesel in terms of the value of the credits and the costs and all of that kind of thing. um, More broadly, they also reflect the difference in the our expectations for feedstock costs. For biodiesel, you can see that we expect margins to remain close to where they are through the end of the month, then a little bit of a drop off, and then a recovery. And if you look at it as an average through the end of the year, it's about 50 cents a gallon, a little bit more or a little bit less in any given month. But around that level, which is a little bit below where we are right now, essentially. Whereas for renewable diesel, we expect that that margins again maybe recover a little bit, but then start to move slowly down towards kind of $2 and 10 cents a gallon, call it, which is just slightly above where they were this week, which was I think 206 or something like that. All right, RIN price forecast. So one of the interesting things, and we didn't make it, just to go through the forecast part of it quickly, we didn't make a lot of adjustments to our RIN price forecast this week. I think we cut prices a little bit. I think the model wanted to go a little bit higher, and I think we trimmed a little bit from where the model wanted to be, which probably left prices about where they were, maybe even a little bit higher. RIN prices have continued to recover from the sort of the June lows, and that's one of the things that I wanted to talk about this week. If you look at the spread between D4 and D6 at those June lows, it was about, I think it was about $9 or 9 cents, I guess. And if you look at it today, it is closer to 15 cents, I think, if I'm remembering the numbers correctly. And that spread really is a function of the market's concern about the ethanol blend wall. Now, while 15 cents still suggests that the market is pretty concerned about the ethanol blend wall, the move towards a wider spread suggests that it's less concerned today than it was in June. And I think the reason for that, it has to do with how the renewable volume obligations, the RVOs, are set at the obligated party level. So you get the mandate announcements, and those are gallon announcements. But at the individual company level, the way that it works is you get it's a percentage of your blending or your production or whatever. And so you don't get you have to use 250 million gallons of biodiesel. You get you have to use 10% or whatever. And so changes in the demand through the year can change your the volume that you have to use through the year. And what I think has happened is that recent data for gasoline demand has been really weak, like suggesting that gasoline demand has fallen below the levels that we saw during the pandemic, when at least part of the country was restricted in their movements and a lot of people were working from home, and you would have expected gasoline demand to be pretty low. Now, it's easy to say that that gasoline prices shot up, and so you had this demand destruction and people have more flexibility in work, and so maybe those numbers are true, and there are some people that are making the argument that maybe the numbers aren't quite what they will end up to be, and there's a history of fairly substantial revisions to gasoline demand going backwards, and so maybe these first estimates are a little bit low. But either way, I think that it's hard to argue against the idea that the rise in gasoline prices has limited gasoline consumption relative to what people thought it would be 6 months ago. And because of that, the gap between projected ethanol production and the implied ethanol mandate, while still there, isn't necessarily as large at the individual level as it might have appeared several months ago. And I think that is probably why you're having this widening of the spread. And again, it's not significant, but the fact is that we would expect the spread to narrow as we move towards the end of the year and as more obligated parties started to um, need to figure out ways to meet their individual obligations. And typically the way that that happens is they produce or buy they produce D4 credits, sell those, and then buy D6 credits, and that's what narrows the spread. And so you wouldn't really expect to see the spread widen as you get closer to the end of the year. You'd expect it to narrow as you get closer to the end of the year. Last year, obviously, the spread widened quite a bit, but that was in part because there was a lot of uncertainty about what the mandate would be. And then once we got some certainty on what the mandate would be, once the administration came out and said, we're effectively going to set the mandate at whatever consumption is, then you can see the impact from being very concerned about the ethanol blend well, when people thought that the mandate was going to be 15 billion gallons here, to once they said that it was going to be set at production, that you got a relatively wide spread. So I say all of that to say that there are two major inputs into our D4 RIN forecast. One is the HOBO spread or feedstock cost, and then the other is the price of the D6 RIN. Now, the HOBO spread, whole nother story. We've seen it bounce back from in nearly double, essentially from late June to Monday. It went from or late July to Monday. It went from sort of around 90 cents to about $1.80. And while that's not a perfect predictor of profitability, it is something that a lot of people pay attention to, and it also is something that has an impact on RIN prices. And so that increase in the RIN prices will naturally lift our forecast for D4 RIN prices, but the the decrease in concerns about the ethanol blend wall will have a little bit of a reverse effect. And so that's why, while the model wanted to raise prices a little bit higher this week, we cut them back a little bit from that. It was a long-winded explanation for a $5 cut, or a 5-cent cut, I guess. All right, LCFS credit prices, and then I'll get to, there's a lot of questions. LCFS credit prices continued to move lower. Last week, we talked a bit about the impact of the LCFS meeting, and maybe there was some strength based on concerns around that meeting. And since there wasn't really any firm decisions made after that meeting, that there was some chance that the LCFS market would then resume its trend lower. We had, for a couple of weeks, had changed our forecast to kind of suggest that the meeting itself and the anticipated changes to the LCFS program might be enough to support LCFS credit prices. Now that the market has sort of resumed its trend lower, we're back to trying to figure out sort of how low the LCFS market can go, and setting our forecasts based in part on that. And what we did this week was we cut our LCFS forecast price in the near term and over the next quarter, and then started to raise it in 2023. The idea is that the LCFS changes, I think they may have one more meeting this summer to talk about the potential changes. Then they're going to come up with a plan and sort of figure out what changes they want to make, and then they're going to implement those changes. And so I think the implementation of those changes would probably be in 2023. And so that's why you see our LCFS credit price forecast start to rise in 2023. If it becomes apparent that either the LCFS program is not going to change, or that the changes will be implemented later than we expect, then those changes really are going to be the triggering point for the change in the trend in our LCFS credit price forecast. Now, they may have another meeting and LCFS credit prices may stabilize or even rally a little bit around that meeting. But given what we've seen happen this past after this last meeting, we probably will continue to stick with the lower trend until we're proven wrong on that, essentially. Okay, let's get to questions because there are a lot of them this week, and I will try my hardest to be as brief as possible. Assumptions for renewable diesel and biodiesel. Okay, I think I covered that, but just in case you didn't get a chance to write it down, they're asking about the feedstock mix for renewable diesel and biodiesel. So for renewable diesel, it's 50% tallow, 25% 25% distillers corn oil, DCO, and 25% used cooking oil, UCO. And for biodiesel, it's 75% soybean oil and 25% yellow grease. Are there price per pound graphs for the margin forecast? We don't. The short answer is no, there aren't. Because we were acquired by Fast Markets, our website is effectively frozen, and so we have not had a chance to change the graphs that appear in on the website based on input from users. That doesn't mean that we haven't developed some of those things so that once we switch over to the Fast Markets website and we can start to add and subtract things and charts again based on user input, that we will. And so if you send me an email, I can send you a price graph that is the sort of margin per pound of feedstock. There's a couple of ways that we dice that up. UCO price forecasting to 2023, our full 2023 forecasts posted anywhere. No, we have a couple of different products. We have essentially three products at the Jacobson. We have the price reporting product, the forecasting product, and then we have a long-term outlook. The price reporting product focuses on the reporting the prices that have happened today, and then things that might impact the market or have impacted the market over the really, really short term, over the next couple of weeks or maybe a month. The forecasting product, which this is, focuses on essentially from now out forward for 1 year. And then we have a long-term outlook that provides price forecasts out for 10 years. So you only get a 1 year slice going forward for this. If you are interested in a longer term price forecast, send me an email and we can talk about how we might be able to provide that to you. When the D4 to D6 spread narrows, you expect both to go up, right? So past the timeline you show mid 2023 or so, you expect both to go up. Yes, if the D6 price goes up, the D4 price also goes up. The relative moves will depend again on the market's concern about the ethanol blend wall or lack of concern about the ethanol blend wall. So if they're not concerned about the ethanol blend wall, the D6 price might go up $5 and the D4 price might go up $10, something like that, I guess. If they are concerned about it, the D6 will move up more relative to the D4, and that price spread will narrow. In that case, the D6 would go up 5 and the D4 would go up 2.5 or something like that. Past the timeline you show, so past sort of the middle of next year, you would expect both to go up. Yes, in general. I think that this year it'll be very informative. This year's spread and the movement in this year's spread and the movement in RINs over the balance of this year will be very informative to what's going to happen next year, because next year is going to look an awful lot like this year, because both years have the supplemental 250 million gallon mandate that falls to the implied ethanol mandate. And that's part of why the gap between ethanol production and the implied ethanol mandate is so large this year. We expect that to happen again next year. Now, if the if gasoline consumption is low, or the spread doesn't narrow as much as we expect it to into the end of the year, we probably will mirror those expectations in our forecast for the end of next year, since the 2 years will kind of look relatively similar. All of that said, if you just said blindly right now, what do I expect? What do I expect in terms of the spread for next year? And I would answer that I would expect it to, and our forecast kind of shows this, start the year relatively wide and then narrow as we go through the year, just based on the fact that as you get closer to the end of the year, people get more worried about making their RVOs. Now, the other part that that can impact RIN prices, obviously, is the feedstock costs. And so, to the extent that we expect feedstock costs, at least at this moment, to come down next year, while you can say that that a narrowing of the spread would support prices for the D4 RIN above levels that the feedstock costs might imply. If you have lower feedstock costs, that also implies lower RIN prices. And so it may be that RIN prices are lower, but because the spread is more narrow, that the RIN price forecast is higher than it would be based on just the feedstock costs alone, if that makes sense. So let's just say that the spread is $10, and soybean oil, just to use it as an example, is 70 cents, and you get a RIN price of $1.90 or something. And next year soybean oil is at 50 cents, but the spread is still unchanged, and you have a RIN price forecast that is $1.60. If the spread was wider, you might have a D4 RIN price forecast that is $1.50 or something like that. Hopefully all of that makes sense. If it doesn't, again, please send me an email, and I'll try to either make it clearer in an email, or we can hop on a call really quickly and kind of go through it. Would like to know your opinion on if we'll see Jacobson Yellow Grease and UCO forecast prices increase given the news of Inflation Reduction Act. The Inflation Reduction Act really had two significant parts to it, or two parts to it, I think, that impact the biomass-based diesel markets. And one was the extension of the blender's tax credit. That's not something we had assumed that the blender's tax credit would be extended anyway, and so that doesn't really change our price outlook or our price forecasts. They're pretty much where they would have been anyway. Typically the blender's tax credit is, I guess historically the blender's tax credit has elapsed, and then Congress fights and fights and fights, and then they renew it retroactively back through the year. And so that's what we expected to happen. The only difference this year from other years is that it appears the blender's tax credit will be renewed before it elapses, which that'll be the first time it's happened. I think it happened in like maybe 2014 or 2015. It's been a while since they renewed it before it elapsed. So from that perspective, nothing has really changed, and there's not really an impact on our outlook for UCO and yellow grease prices. The other part that was different and was not it was expected, but not necessarily in this bill, was the new SAF credit, and that is $1.25 to $1.75 per gallon credit, depending on the greenhouse gas reduction. And so I assume that that means $1.25 is for soybean oil, and $1.75 is for UCO. The thing with that is that SAF production is so small right now, and while it is likely to grow pretty quickly over the next 5 years or so, we don't expect it to be a significant factor for a couple of years. And so in terms of our short-term outlook for UCO prices, it doesn't really have an impact. In terms of our long-term outlook for prices, it probably will have an impact, but we also already have an increase in SAF built into our model. And so it doesn't necessarily change our expectations that much. Now we'll see how much the credit incentivizes renewable diesel producers or ethanol producers to increase SAF production capacity. If there's a big ramp up in SAF production capacity, then we probably will change then we definitely will change our forecast for production. And then that would have an impact on our UCO price outlook, and um, it would tend to drive it higher. Although again, I think if we are at or close to this level where we're essentially using up all of the additional fats and greases, then it may be that UCO prices are at or close to their theoretical maximum high. I guess if everybody wants to use UCO and they bid on it, it could go higher, certainly. But there does seem to be sort of a limit to how high these prices can go. All of that said, there are sources of UCO that probably aren't economical to recover right now, and the SAF credit may make those more may make it economical to recover those. So you could also have this offsetting sort of increase in supply of UCO that again may limit the increase in price, even if you do have a big increase in demand from additional SAF production. Used cooking oil services can enter into short forward contract to hedge any price volatility in UCO prices. Is this an action you can recommend? What I can recommend is we have a colleague named David Becker, and David Becker heads up our risk management department. And David can talk to you about several ways to hedge your UCO price exposure, and in some cases provide better protection than the short-term fixed price contracts that you can get from suppliers. So if you'll send me an email, I will introduce you to David, and David has been on the call and kind of talked about what he does before. We're going to have him back on here in a couple of weeks to talk about kind of the same stuff, but in a little bit different way. And so I would suggest that you send me an email and I will make the introduction, and then you guys can talk about it. David knows, just to give you a quick background, David was a derivatives trader at Goldman and knows quite a bit about hedging and how to hedge these kinds of products that don't have futures markets associated with them. All right, that was a lot. Thanks for hanging in there with me this week, everybody. And thanks for showing up. And I look forward to seeing you all next week. Have a great week.